I'm Amanda Lynn, a luxury real estate advisor and entrepreneur. I work with high net worth clients and focus on smart, long-term wealth through real estate. Let's dive in. Imagine saving $175 every single month on your mortgage payment. Sounds incredible, right? You refinance your $300,000 mortgage from 6.5% down to 5.75%, and suddenly you're pocketing an extra $2,100 per year. But here's the catch. Those closing costs just hit you for $6,000. So are you actually saving money, or did you just make a very expensive mistake? The answer lies in one simple calculation that most homeowners never do, the break-even point. And by the end of this video, you'll know exactly when refinancing puts thousands of dollars in your pocket. What is refinancing? Before we crunch the numbers, let's get crystal clear on what refinancing actually means. When you refinance your mortgage, you're not adjusting your current loan. You're completely replacing it with a brand new one. Think of it like trading in your car, but for your mortgage. Your new lender pays off your old loan entirely, and you start fresh with new terms, a new interest rate, and yes, new closing costs. The process looks almost identical to when you first bought your home. You'll submit an application, provide financial documents, get a home appraisal, and go through underwriting. The lender checks your credit score, verifies your income, and assesses your home's current value. And just like your original mortgage, you'll pay closing costs, typically between 2% to 6% of your loan amount. For that $300,000 loan, we're talking $6,000 to $18,000 up front. But here's why people do it anyway. Refinancing gives you three main opportunities. You can lower your interest rate and reduce monthly payments. You can change your loan term to pay off your home faster or stretch out payments, or you can tap into your home's equity for cash. Each of these has very different math, very different risks, and very different outcomes. So let's break down when each one actually makes sense. When to refinance interest rate drop. Here's the golden rule that mortgage experts swear by. Refinancing typically makes sense when you can drop your interest rate by 0.75% to 1%. Notice I said 0.75 to 1%, not a quarter of a percent. That small difference is absolutely critical. Let's look at real numbers. Say you have a $300,000 mortgage at 6.5% interest. Your monthly principal and interest payment is $1,896. Now rates drop and you can refinance to 5.75%. Your new payment becomes $1,751 per month. You're saving $145 every single month, which adds up to $1,740 per year. Over 5 years, that's $8,700 in your pocket instead of the bank's. But, and this is the big but, you've got to subtract those closing costs. If closing costs are $6,000, your actual savings over 5 years is only $2,700. Still good, but nowhere near that headline number of $8,700. Now here's what happens if you chase a smaller rate drop. Let's say you refinance for just a 0.25% reduction, going from 6.5% to 6.25%. Your monthly savings shrinks to about $48. With the same $6,000 in closing costs, you'd need to stay in your home for 125 months, that's over 10 years, just to break even. And most people move or refinance again within 7 years, meaning they actually lost money on the deal. According to recent banking studies, borrowers with 30-year mortgages need at least a 0.75% rate drop to break even in under 3 years, which is the sweet spot financial advisors recommend. If you've got a 15-year mortgage, you can benefit from an even smaller drop, sometimes as little as 0.5%, because you're paying more principal each month, so interest savings stack up faster. The break-even calculation. All right, let's talk about the single most important calculation in this entire decision, your break-even point. This is the magic number that tells you exactly when you start actually making money from a refinance. And the formula is dead simple. Take your total closing costs and divide them by your monthly savings. That's it. The result tells you how many months you need to stay in your home before the refinance pays for itself. Here's a real example. You're refinancing that $300,000 mortgage from 6.5% to 5.75%. Your monthly payment drops from $1,896 to $1,751, a savings of $145 per month. Your closing costs come in at $6,000. So you calculate $6,000 divided by $145 equals 41 months. That's 3.4 years. What does this mean? If you plan to stay in your home for more than 3.4 years, refinancing is a win. You recoup your costs in just under 3.5 years, and every month after that is pure savings. But if you're planning to sell in 2 years, you'll lose $2,520. That's the $6,000 in costs minus only $2,520 in savings over 24 months. Now, here's where people mess this up. They look at monthly savings and think, wow, $145 a month, that's great. But they forget to factor in that they've essentially taken a $6,000 loss up front. You're not really saving $145 a month. You're recovering your $6,000 investment at a rate of $145 per month. Only after month 41 does that become true savings. The break-even point is your line in the sand. If your timeline is shorter than your break-even point, refinancing costs you money. If it's longer, refinancing makes you money. It's that simple and that brutal. When to refinance shorten loan term. Now let's talk about one of the most powerful but underutilized refinancing strategies, shortening your loan term. This is when you refinance from a 30-year mortgage down to a 15-year mortgage. And the numbers here are absolutely staggering. Picture this. You have a $300,000 loan at 6% interest on a 30-year term. Over the life of that loan, you'll pay approximately $347,000 in interest alone. Now you refinance to a 15-year mortgage at 5.25%. Your total interest drops to about $126,000. That's $221,000 in interest saved. Let me say that again, $221,000. But here's the catch, your monthly payment goes up. With the 30-year loan at 6%, you're paying around $1,799 per month. With the 15-year loan at 5.25%, that jumps to roughly $2,406. That's an extra $607 per month out of your budget. So why would anyone do this? 3 reasons. First, you build equity in your home at lightning speed. Instead of most of your payment going to interest in those early years, you're knocking down principal with every payment. Second, you own your home free and clear in half the time. Imagine being mortgage-free 15 years earlier. That's 15 years of retirement without a house payment. And third, shorter-term mortgages almost always come with lower interest rates because you're less risky to the lender. This strategy works best if your income has increased since you bought your home, or if you're approaching peak earning years and want to aggressively pay down debt. It's not for everyone. That higher monthly payment has to fit comfortably in your budget. But for those who can swing it, the long-term savings are enormous. When to refinance ARM to fixed. Let's talk about a refinance scenario that's more about protection than savings, converting an adjustable rate mortgage to a fixed rate mortgage. If you have an ARM, you know how this works. You get a low introductory rate for a set period, usually 5, 7, or 10 years, and then the rate adjusts, often upward based on market conditions. Here's the problem. When that adjustment period hits, your payment can skyrocket. In 2026, with economic uncertainty and fluctuating rates, homeowners with ARMs are increasingly nervous. If your 5-year ARM is about to adjust and interest rates are climbing, refinancing to a fixed rate mortgage locks in predictability. Let's say your ARM started at 4.5%, but it's about to adjust to 6.5% or higher. Your payment on a $300,000 loan would jump from about $1,520 to $1,896. That's an extra $376 every month, or $4,512 per year. Refinancing to a fixed rate around 6% might cost you up front, but it protects you from future increases and gives you payment certainty for the next 15 or 30 years. The best time to do this is before your ARM adjusts, not after. Once your rate increases, your debt-to-income ratio changes, which can make it harder to qualify for favorable refinance terms. If you know your adjustment is coming in the next 6 to 12 months, start shopping for fixed rate options now. When to refinance, cash out refinance. Now let's talk about the cash out refinance, the most tempting and potentially the most dangerous refinancing option. This is when you borrow more than you currently owe and take the difference as cash. Here's how it works. Let's say you owe $200,000 on your mortgage, but your home is worth $400,000. You have $200,000 in equity. With a cash-out refinance, you could refinance for $250,000, pay off your $200,000 loan, and pocket $50,000 in cash. Lenders typically let you borrow up to 80% of your home's value, so you'd need to leave at least $80,000 in equity untouched. Now, when does this make sense? Cash-out refinances are smart for three specific purposes. First, consolidating high-interest debt. If you're carrying $30,000 in credit card debt at 22% interest, paying it off with a mortgage at 6% saves you a fortune. Second, funding home improvements that increase your property value. Think kitchen renovations, adding a bathroom, or finishing a basement. Third, covering major life expenses like college tuition, where mortgage rates beat student loan rates. But here's the trap. Cash-out refinances increase your loan balance, increase your monthly payment, and reset your mortgage clock. If you've been paying your mortgage for 10 years and you cash out refinance to a new 30-year loan, you're back at square one. And if you use that cash for discretionary spending, a vacation, a new car, a wedding, you're essentially converting your home equity into consumer debt. That's a recipe for financial disaster. The golden rule: only use cash-out refinancing for investments that build wealth or reduce higher interest debt, never for lifestyle expenses. When not to refinance. We've covered when refinancing makes sense. Now let's talk about when it's a terrible idea, because this is where people lose serious money. First, you're selling your home within 2 to 3 years. Remember that break-even calculation? Most break-even points are 2 to 5 years. If you're planning to move before you hit that mark, you're literally handing money to your lender for nothing in return. Second, you're already halfway through your mortgage term. Here's why this matters. In the early years of a mortgage, most of your payment goes to interest. But as time goes on, more goes to principal. If you're 15 years into a 30-year mortgage, you've already paid the bulk of your interest. Refinancing now restarts that clock. You go back to paying mostly interest again. Even if your rate is slightly lower, you could end up paying more in total interest over the life of the loans. Third, you need to apply for other credits soon. Every time you apply for a refinance, lenders do a hard pull on your credit, which can drop your score by 5 to 10 points temporarily. If you're about to apply for a car loan, business loan, or credit card, that dip could cost you a better rate or even approval. Wait until after you've secured that other credit. Fourth, you plan to spend cash-out proceeds on discretionary items. If the words vacation, boat, or new wardrobe are anywhere in your refinancing plan, stop. Do not pass, go. Do not refinance. You're converting long-term secured debt into short-term consumption, and that's financial self-sabotage. Costs to expect. Let's get specific about what refinancing actually costs, because closing costs is a vague term that hides a lot of individual fees. Here's the breakdown. Origination fees. This is what your lender charges to process your loan, typically 0.5% to 1% of the loan amount. On a $300,000 loan, that's $1,500 to $3,000. Appraisal fee. Your home needs to be appraised to determine current market value, costing $400 to $600 for most homes. Title search and title insurance. This ensures there are no liens or ownership issues with your property, running $700 to $1,000. Credit report fee, usually $30 to $50 per applicant. And you might pay for things like recording fees, flood certification, and underwriting fees. Add it all up, and you're typically looking at 2% to 6% of your loan amount. For a $300,000 loan, that's $6,000 to $18,000. The variance depends on your lender, your location, and whether you buy discount points to lower your interest rate. Each discount point costs 1% of your loan and drops your rate by roughly 0.25%. So 1 point on a $300,000 loan costs $3,000 but could reduce your rate from 6% to 5.75%. The key takeaway: always get a loan estimate from each lender you're considering. By law, they must provide this within 3 days of your application. Compare the total closing costs and the APR, not just the interest rate, to see the true cost of each loan. 2026 Refinance environment. So what's happening with mortgage rates right now in 2026? As of January, the average 30-year fixed refinance rate is hovering around 6.2%, down nearly a full percentage point from this time last year when rates were above 7%. That's significant. Analysts at Fannie Mae predict rates will settle around 6% for most of 2026, with some forecasts suggesting a brief dip into the high 5% range by mid-year before climbing back up. The Federal Reserve has signaled potential rate cuts, which historically puts downward pressure on mortgage rates, but inflation concerns keep things volatile. What does this mean for you? If you locked in a mortgage at 7% or higher in 2023 or 2024, right now might be your window. That 0.75% to 1% spread we talked about earlier is within reach. But here's the critical advice. Don't try to time the market. Rates could dip lower or they could jump back up. The question isn't, are rates at their absolute lowest? The question is, does refinancing at today's rates meet my break-even timeline? If the math works today, lock it in. Waiting for the perfect rate often means missing good rates altogether. No closing cost refinance. You've probably seen ads for no closing cost refinances, and they sound amazing. No $6,000 up front? Sign me up, right? Not so fast. No closing cost refinances aren't actually free. Lenders recoup those costs in one of two ways. Either they roll the closing costs into your loan amount, increasing what you owe, or they charge you a slightly higher interest rate. Let's say your closing costs are $6,000. Option 1, you refinance for $306,000 instead of $300,000, and now you're paying interest on that extra $6,000 for the life of the loan. Option 2, instead of a 5.75% rate, you accept 5.875%. That extra 0.125% might only cost you $25 more per month, but over 30 years, that's $9,000, significantly more than the $6,000 you avoided up front. No closing cost refinances make sense in one specific scenario. You're right on the edge of your break-even point, or you're not sure how long you'll stay in the home. If you think you might move in 3 to 5 years, avoiding the upfront cost and accepting a slightly higher rate could work in your favor. But if you're planning to stay long-term, pay the closing costs up front and lock in the lower rate. Credit score requirements. Your credit score is the gatekeeper to refinancing. Here's what you need to know. For a conventional refinance, most lenders require a minimum credit score of 620. But here's the reality. 620 gets you in the door, but it doesn't get you the best rates. If your score is between 620 and 680, expect to pay a higher interest rate. Between 680 and 720, you'll get better terms, but the sweet spot is 720 and above. That's where you unlock the lowest rates and save the most money. Here's the kicker. Every 20-point increase in your credit score can drop your interest rate by roughly 0.25%. On a $300,000 loan, that quarter-point difference can save you $40 to $50 per month or $14,400 to $18,000 over 30 years. Before you apply for a refinance, pull your credit report. Look for errors, incorrect late payments, accounts that aren't yours, outdated information. Dispute anything that's wrong. If your score is hovering around 680, it might be worth spending a few months paying down credit card balances and making on-time payments to push into the 700 plus range. That delay could save you tens of thousands of dollars. Action steps. All right, you've got the knowledge. Now here's exactly what to do. Step 1, check current rates versus your existing rate. If the difference is less than 0.5%, refinancing probably doesn't make sense unless you're changing your loan term or eliminating PMI. If it's 0.75% or more, move to step 2. Step 2, calculate your break-even point. Take realistic closing cost estimates. Assume 3% of your loan amount if you're not sure, and divide by your monthly savings. If your break-even is longer than you plan to stay in your home, stop here. Step 3, get quotes from at least 3 to 5 lenders. Don't just talk to your current lender. Shop around. Credit unions, online lenders, and big banks all offer different rates and fees. Request a loan estimate from each and compare them side by side. Step 4, compare APR, not just interest rate. The APR includes fees and gives you the true cost of the loan. A 5.75% rate with $8,000 in fees might have a higher APR than a 5.875% rate with $4,000 in fees. Step 5, lock your rate when you're comfortable, not when the market is perfect. If the numbers work for your break-even timeline, lock it in. Conclusion. Here's the bottom line. Refinancing your mortgage is a tool, not a magic solution. It can save you tens of thousands of dollars or cost you thousands, and the difference comes down to one thing: math. Not emotion, not hype, not what your neighbor did. Cold, hard math. Run your break-even calculation, know your timeline, understand your costs, and never ever refinance just because rates dropped or because someone told you to. Refinance when the numbers prove it's the right move for your specific situation. So here's my question for you. Have you calculated your break-even point? Drop a comment below and let me know where you're at in your refinancing journey. If this video helped you understand when refinancing makes sense, or saved you from making a costly mistake, smash that like button. Share this with anyone who's considering a refinance because this is information that literally saves people thousands of dollars. If you enjoyed this, go ahead and hit that subscribe button so you don't miss future videos where we break down exactly how money works. See you in the next one.